Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CDB Leasing, interim report. China Development Bank Financial Leasing Co., Limited, offers a diverse range of leasing services across various industries. The company's business segments include aircraft leasing, commercial aircraft acquisition and leasing, regional development leasing, urban and transportation facilities, key industrial equipment, and national policy-supported projects, ship leasing services inclusive finance, vehicle and construction machinery leasing, green energy and high-end equipment leasing, energy infrastructure and high-end equipment leasing. These segments demonstrate the company's broad scope of operations, catering to various sectors such as transportation, industry, and renewable energy. The significant increase in CDB Leasing's stock price over the past year can be attributed to several key factors. The company's strong interim results for the 6 months ending June 30, 2025, with a net profit increase of approximately 27.63% year-on-year, demonstrate its profitability and operational efficiency. Additionally, analyst optimism is evident through CMBI Securities' strong buy rating, while institutional confidence in the stock is reflected by CITIC Group Corporation's increased holdings. The robust commercial activity reported by CDB Aviation, a subsidiary of CDB Leasing, further supports the company's growth prospects. The receipt of $140 million in insurance settlements for grounded Russian aircraft and the confirmation of sale talks also contributed to the upward trend. Furthermore, China Development Bank Financial Leasing's decision to call its $700 million 10-year notes issued in 2020 may have been perceived positively by the market, further driving up the stock price. Overall, a combination of strong financial performance, analyst optimism, and strategic business activities has contributed to CDB Leasing's significant stock price increase over the past year. The primary drivers of revenue growth or decline in a company's financial performance can be identified through an analysis of its income statements. In this case, several key factors contribute to revenue growth. Revenue growth is primarily driven by finance lease income, which has seen significant increases across various segments, including aircraft leasing, plus 385.7% and plus 29.4%, and the green energy segment, plus 13.6%. Operating lease income also contributes to growth, with increases in aircraft leasing, plus 3.2%, ship leasing, plus 4.7%, and regional and high-end aircraft development segment, plus 13.6%. In contrast, revenue decline is largely attributed to operating lease income, particularly in regional development leasing, minus 36.7% and minus 38.9%, and ship leasing, minus 18.5%. Finance lease business overall also experiences a decline, minus 6.2%. Net investment gains also contribute to the decline, minus 50,418. Overall, finance lease income and operating lease income are the primary drivers of revenue growth or decline in this company's financial performance. Net income and profit margins. A changing landscape, the company's net income has undergone significant fluctuations since its listing in 2016. Initially, it improved, but a decrease of 5 percentage points was observed due to finance lease income. However, this trend reversed with a notable increase of Rm 1,176.5 million, representing a 29.2% year-over-year growth. Profit margins have also experienced changes. The company maintained a robust return on equity ROE above 10% since its listing. Nevertheless, the finance lease income profit margin decreased from 34.4% to 29.4%. Conversely, operating income and net profit margins saw significant increases of 7.7% and 27.6%, respectively, year-over-year. These changes reflect shifting dynamics in the company's financial performance. The company is generating positive operating cash flow, as evident from the significant increase in cash and bank balances over the past year. The net cash inflow from operating activities has also seen a substantial decrease, indicating a strong financial position. This trend suggests that the company's operations are generating sufficient funds to cover its expenses, resulting in a positive operating cash flow. The company's financial performance reveals a notable decrease in interest expenses over the past 2 years. Specifically, interest expenses dropped by 31.4% from RMB 6,727.7 million in 2024 to RMB 4,617.1 million in 2025. This significant reduction is a positive indicator of the company's financial health. However, the debt level has shown a slight increase. Total liabilities rose by 2.8% from RMB 365,586,571 in 2024 to RMB 376,106,272 in 2025. Despite this minor uptick, the overall trend suggests that the company is managing its debt effectively. In summary, while the company's interest expenses have decreased substantially, its debt level has increased slightly over the past 2 years. The company's financial performance varied across different segments and regions. The green energy and high-end equipment leasing segment consistently performed well, reporting significant increases in revenue and profit before income tax. Inclusive finance also showed strong initial growth, but experienced fluctuations, with a 48.6% increase, followed by a -19.2% decrease. On the other hand, regional development leasing and ship leasing segments struggled, with consistent decreases of -36.7%, -38.5%, -18.5%, and a decline in operating lease income. Aircraft leasing showed inconsistent performance, initially reporting a significant increase, then a small increase, and finally a significant decrease. Management is optimistic about the company's outlook, citing significant growth in its leasing business as a result of its business transformation. Despite market challenges, the company remains committed to intensifying operations in the shipping market through research and analysis. It aims to maintain a high standard in vessel utilization rate and safety conditions. The company is also focusing on inclusive finance, optimizing asset structure layout, and expanding coverage of inclusive finance services. Additionally, it is actively aligning with national strategic priorities, increasing investments in dual carbon goals and advanced manufacturing sectors, and focusing on the green energy market. Management emphasizes prudent operation and sustainable development, prioritizing remuneration management linked to performance and risk control. The company's asset quality remains strong, with a low non-performing asset ratio of 0.63%. Overall, management is confident in the company's ability to navigate challenges and achieve growth, while maintaining a strong reputation and commitment to sustainability. The company has made significant transactions in the past year, both acquiring and divesting various assets to optimize its operations. In terms of acquisitions, the company has purchased aircraft leased assets for RMB 1,268.4 million, executed sale and leaseback deals, and acquired portfolios of assets. These moves are likely aimed at expanding the company's fleet and increasing revenue streams. On the other hand, the company has also engaged in divestitures, selling 31 new and used aircraft and engines through remarketing and extensions, as well as a portfolio of assets. This suggests that the company is streamlining its operations and focusing on core activities. The company's financial summary reveals a clear indication of its commitment to shareholder value. Specifically, it has been confirmed through multiple sources that the company has indeed paid dividends in both 2024 and 2025. This demonstrates a consistent effort to return profits to shareholders. In contrast, there is no evidence suggesting that the company has engaged in share buybacks. That concludes the financial summary for CDB Leasing. Feel free to comment below, and I will be happy to answer them when possible.